the less risk you're assuming with your options, right? Because if you're looking at in the market that we're trading today, it's much more volatile than it was years ago. Like years ago, options were good. Like back in the 70s when options first came out, they were really good because like the market was like, it would do like a very slow grind up, and it would like chop around a little bit, and it wouldn't be like super bullish. It wouldn't be super bearish just because there wasn't enough volatility. There wasn't enough people like churning up the market. It was just institutions and like small amounts of retail just slowly loading the market, making profit where they could. So that's where options kind of gave them the advantage. It came in and gave them another tool on their tool belt. So in the late 70s, they originally came out with call options because that's what you were trying to do in the market. You're trying to hedge your major positions as you're buying. You can hedge it with call options to the downside. So that's what institutions were using them for. They needed to, use their positions. And then I believe that was in 73. And then in 77, they came out with puts because they wanted to take advantage because they were buying and selling their stocks, and they were able to buy the call options to hedge it. And then, greed takes over and people want to, utilize more tools in the tool belt, and they get something like puts. So now we have calls and puts years later, but we're talking about time frames. And in the world that we're living in today, what I'm getting to is that it's extremely volatile. So time is all the more relevant because if you're buying an option, for instance, if the market is extremely volatile, right? It's extremely volatile. We're experiencing extreme volatility. Your options, all time frames on options, they're going to be drastically more expensive. You're going to be paying a premium on that time because in that time frame, they're expecting a lot more to happen, right? So that's how time affects the options. If it was low volatility and the time frame, like let's say on a scale of 1 to 10, if we were at like 2 volatility, right? And you're looking at a time frame option for a week out. If you're only moving at a 2, you can kind of anticipate in terms of volatility. You can kind of anticipate the range that you're going to move up and down for a stock if the volatility is 2, right? That makes, in a week, it's only going to move so much if the volatility is 2. It's not, it's not extremely unexpected. But if the volatility is 5, 6, 7, 8, 9, 10, like some of the environments that we've been exposed to in, past 3 or 4 months, that time frame is much more relevant to your option, right? That's why we're getting such drastic swings in terms of appreciation in stock options. You can get an option that's going to explode, 5,000% in appreciation, and that's because you got such a direct, acute amount of volatility within a specific stock, which blows out the time frame, the time frame that they were projecting the stock to move. It blows it out of proportion. It blows it out of the sky. You couldn't even predict this type of volatility, this type of appreciation. So that's what time, that's how time really affects the stocks with the volatility, right? So that's kind of what you're looking at. The more time, the less risk you're assuming. Even in a more volatile market, chances are the volatility is going to fade and market prices will stabilize. So that's where your strike price is going to come in, right? So it all comes together. When you're buying an option, everything that you're trying to trade, it all comes together. If anybody wants to stop and for me to, answer a question on anything I've spoken, just text in the chat. And everybody can hear me now, right?
Yep.
So it all comes together. When you're buying an option, you're buying the whole shebang. You're buying the price that it's traded at. You're buying the time frame. You're buying the rate, the volatility that you're seeing, which is going to be your rate of change, your data. And it's a package deal. It's great. The market is more than happy to supply you with another tool to your tool belt as long as you understand what they're giving you, right? And that's where interpretation of value is a big key, right? Where I was talking about Warren Buffett earlier today and stuff like that, but interpretation of value. For instance, if you look at a stock option, you can look at a stock option try to think of a quick example here, like Sprint, for instance. Sprint a couple of weeks ago, a stock option, a call option for Sprint, maybe into the $5, $6, $7, whatever it moved to. So if you were to buy that call option, let's say we were buying before the merger news with T-Mobile and all that shit started coming out, right? Think about a stock like Sprint. So Sprint is kind of fading off. It's kind of in the weaker part of the sector. It's not really well established with the other big, telecommunication, marketers. They haven't really spent that much in advertising. They don't have as big as much market base. They're really overwhelmed by Verizon, AT&T, things like this. And so, T-Mobile, we're talking about Sprint. Sprint had a really tough time in the market. So their stock was displaying this. It's depreciating. It's in a down slope. you know, it's getting beaten up. It can't increase in price. So these call options, if you think about it in terms of, you know, any type of a time frame on a sprint before the merger news, any time frame would have worked, right? Because they're expecting sprint in this type of an atmosphere with this type of a sentiment. It was very bearish or very, very directional towards the downside, right? So the call options would have been cheap because that's what they're predicting. That's what the projection is. That's what they're relying on. That's where you would essentially be buying, you know, good cheap call options that you could potentially make a good amount of money on. For something like merger news comes in, for instance, and you get heavy volatility, no matter what your time frame was. If you were projecting the price to be $6 in a week, $6 in a month, $6 a year, it doesn't matter. You're going to be affected. But the amount that you're going to be affected is based off that time frame. For instance, a 3-month call option is going to be affected, you know, 30%. You know, let's say 3 months out, you're going to be affected 30%, and then 6 months out, you're only going to be affected 10%. You understand what I'm saying? So like, that's where time, like, it gives you the value. It gives you extra time. It gives you extra what's leeway, if you want to call it that. But it costs you. You're paying for that time. You're paying for the time that you're going to be relying into this option. Because they're more than happy to give you the option, but you're going to be paying for the time that you're holding the option to execute it or to sell it for a premium, to do whatever you're going to do. So that's where time frame and your strike price obviously comes into factor. You base your strike price off of support and resistances, right? So years and years ago, when the market was much less volatile, they would use the options for choppy markets, basically, because they would look at the market. They would be sitting in a position. There's long positions. They're sitting in the long positions, and they're waiting for appreciation. And they're loading up, and they're not making what they want to be making. So that's like, they're like, oh man, this sucks. They can't pump it up high enough. They don't have enough money. They don't have enough cash. You know what I'm saying? So they wanted to make money. That's when something like a call option or a put option gives them another tool in their tool belt, because they can make money on a much smaller move, like for instance, a dip or a short-term rip or something like that, based off of short-term support and resistances, and capitalize on those small moves using a small amount of money or capital and leveraging that capital through options. So that's kind of like where it was like, it's a hedge to counter their risk. You're countering your risk, but at the same time, it's a hedge to ensure that you're still going to assume as much gains or appreciation as you anticipated, or that you're striving to get. So that's really where option gives you the advantage. It can give you that extra push that you need, to make your position profitable, even when it's not going your way. And that's really the basis of options. It's like, and there's multiple ways that you can go about options. You could play a neutral option. You could play a negative option, a bearish option, a bullish option. You could play an indirect option. Like, there's so many ways to play options that's what it gives you. It gives you the strategic edge to use these things to your advantage, if you're able to interpret the value and the probability of these things happening. Because the market is going to take advantage of it, and that's where it's the more like a really in-depth explanation of how options work. But the market takes advantage of this money. For instance, if you see that, you're going to see, like, I don't know if anybody follows like black box stocks or something like that in here, but they run a lot of option scams with like calls, call sweeps and put sweeps and stuff like that. And what they're saying is that there's tons and tons of money that was accumulating calls and puts at certain prices, that's now the market, whatever they're trading off of, is being manipulated to ensure that those calls or those put options they're not profitable, because the market wants to take advantage of the money that's sitting there. If you have like $50,000, it's really hard to get into the numerical values of it, but if the money is pumping up to the bullish side, so much so that it supersedes the amount of price action that it's going, the actual the equity that you're trading is going to see, then the money essentially becomes better to short it and take advantage of it that way, and you're going to see a bigger swing. And that has to kind of do with, like, I can't remember the example that he gave to you in the speech, but that has to do with like the pendulum that he's talking about. The like push and pull that I was talking about earlier with the yin and yang. When things get too much to the one side, it's like more likely to push against and go towards the other side. And it's like, it's a counter trend idea, but that's because it's based on the likelihood of what's currently happening. You know what I'm saying? So that's kind of like time frames, like strike. How do you determine your strike is going to be based off those support and resistances? Those support and resistances that you're looking at are kind of determined on your time frame, right? You're not going to pick a support, a near-term support, or like an acting support on something that's moving volatilely. You're not going to use an acting support, for instance, on a long-term put or a call. You're going to use a long-term support and resistances because you're making a long-term projection. That's where the time frame scales in. You use if you're going to day trade, you're going to play. You're going to play an option that expires today. You're going to play an option that expires maybe tomorrow. You're going to day trade. Every day you're going to buy and sell options based upon the next day or the day before, or that next day. That's day trading options. But that's not really what options are intended to do. That's how options today are being used for as a new strategic method in order to make money, because you can capitalize on those extreme situations where unexpected volatility is being injected into the market and this money is being flowed into, and you have these options that are obviously going to increase in value because of it. It's a nice thing to be It's a good thing that potentially could be taken advantage of on a day-to-day basis, and people do. They trade options very effectively, and their ability to do so is based on liquidity. You know what I mean? And that's what anything comes down to. When you trade a stock, your ability to buy and sell at any given price is based on liquidity. It's the same thing with options. If you have an option, that expires, today, and it's very unlikely that it's going to happen, nobody's going to want to buy that option. If they do want to buy that option, it's going to be super cheap. And that's based on liquidity. Somebody has to buy that option. Somebody has to pick up that contract. And that's the give and take. That's the, just like anything else in the market. For every buyer, there's a seller. It's the, same thing. So let's get some more questions. What else you guys got? What about you, Ziggy? What are your questions?
I want to let everyone else go because mine is just big picture where I'm more of a noob than you can even imagine. Like, you see what I had pinned? Those aren't my questions. Those are what we were considering covering in the first place.
Oh, I didn't even look at those. Hold on.
So, sorry, my mom just got home. So, all that stuff, I don't even know how to apply the Greeks beyond delta.
But you don't even see, all of this. If you're looking at, this is, where it really comes down to, this. That's why I was asking you, what kind of a class this is going to be, because there's an analytical, technical analysis that takes place when you're calculating these types, when you're buying and selling options, you're playing a numbers game that's generated also off of probability, right? And historical data. That's where that's why you're buying a block of time, and the projected value of a stock to either depreciate or appreciate within that block of time. So it's like playing. That's what I don't know how to explain basics for me, because I get a very over complex way of thinking about it. Data is time. So these are all. I mean, come on, you're gonna go over Greek symbols. Everybody should know your Greek symbols.
Right. So we can have the definitions. We can post links and all that. So I guess I can ask. I guess I'll go to the question is. My question isn't really what we had pinned and everything. So I guess a lot of the stuff with how we're learning trading and the big differences, whether you're reading a big book, you learn nothing, you don't know anything, you only know the big picture stuff. So we can learn all these definitions, all that shit. Doesn't matter. I know how to trade stocks. Can't do the option.
Exactly. You can watch a 3 to 5 minute video on YouTube that will explain to you.
I think as a group we should just pick a ticker, look at it, assess it, and do it. Because my biggest problem is when I'm like, oh, this would probably make a great option, I have to go hit up Jeff or hit up someone else in the group. I'm like, which one should I do? Like, oh, go find the one with the most open interest. I'm sitting there on Robinhood going to all the other ones. And it's not that you don't know what's probably a good idea. You just don't know what the best idea is, and that's what numbers.
Okay. So that's a good question. Okay, so that's a good thing. Let's talk about that. So when you're talking about open interest, the reason why open interest is so important is because, I was talking about liquidity, right? You need people to be able to buy and sell at the price that you're looking at, or the time frame that you're looking within. You need to make sure there's going to be buyers and sellers within this time frame, right? And that's where the amount of money, your strategic use of option is completely up to you. You can use options to be 10% aggressive, 20% aggressive, 30% aggressive, 40% aggressive, 50% aggressive. You can go as risky options as all hell, or you could go as conservative options as absolute heck. You know what I mean? And that's where you really need to figure out like what you're trying to do with options. Are you trying to hedge your long-term positions and make sure that you're going to be profitable in the long term? Or are you trying to take advantage of small moves in the market using options and taking advantage of small time frames within the market and the volatility that you think that you're going to see within these tickers?
Right. No, absolutely. And I guess everyone else, you could probably say for them, we still don't know how to do it at that point, because I guess the real answer is you need to just make a decision and execute on it. So what I think is, let's just use an example where it's applicable, where I was confused when I first started learning. I still don't get it. So if we're at, let's random number, like $20, and we want to buy a call, why would we ever buy a call for under the price that we're at? Like, when it's in the money, out of the money, like I still don't understand in the money, out of the money, and that is a basic concept.
That's a good question. That's a good question. That's a good question. That's a good question. Okay, so that's a good question. So we're at $20, right? We're at $20, and you're saying, so if you're going to call, you expect the price to go higher, right? That's what a call option is. You're bullish. You're buying a future higher price. That's what a call option is. So he's saying, if I'm buying it, am I sitting at $20? Why would I buy a $19 call option? And this is what it comes down to. This is where calculating all the numbers and generating all that things gives you a distinct value of why you would or would not do this. And this is the easiest. I'm going to try to explain this as simply as I can. So basically, if you had a picture the stock is at $18, right? Picture the stock is at $18, and you buy a call option for 3 weeks ahead, or no, let's say 3 months ahead. 3 months ahead, okay? The stock is at $18, and you buy a call option for 3 months ahead. And the stock goes up, the stock is going up, the stock is going up. The stock is at $20 now. But you don't want to sell your call option. We're only 3 weeks into your 3 months. You bought a 3 month block of time. You bought a 3 month block of time. You have an $18 call option. So your call option is not going to expire. Your call option is going to be alive until the expiry date. You can trade it. You can buy it and sell it. You can do whatever you want with it. You can sell it for a premium. You could, that you're good. You've hit your target. But you're going to milk that option for as much as you can within that time. You bought that block of time. You bought that. You assumed that risk when you purchased it. So that's why the option is still there. If you want to buy that $19, you still can. Because if the stock price goes up, like let's say that $19 call option is, let's just make it very simple, 100% in the profit. And we're at $20. If the price goes up to $21, that $19 call, that $20 call is going to be now, let's say, keep it very simple, $150 in the profit, 150% in the profit. Does that make sense? So, yeah. So if you bought that $19 call from that dude who wanted to sell it, like I said, that's where open interest comes into play and liquidity. Because if there's not a guy willing to sell his $19 call option because he thinks that this price is going to go to $22, $23 in the next 3 months, guess what? He's not going to sell it to you. Or you're going to overpay for it, right? You're going to pay more. You're going to pay a premium on that price, right? So if you're looking at, a range for that option, let's say it was trading at 60 cents to, I'm just using numbers here. It was trading at 60 cents to $1. You're going to pay $1, if not more than $1. So God forbid if anything happens to that stock price, it doesn't go to 20, it goes down to 19.50. You're going to be on the shit end of that stick. You're going to experience, you bought something that was in the money that's going to go less in the money. So you're just assuming that extra risk that dude wanted to sell to you because he wanted to get rid of his call option. He wanted to sell you the time that it had left. Does that kind of make sense?
Yeah. So two things. One, for all of us and myself, can we define in the money, out of the money? The stock itself is at $20. In the money is above or below?
On a $20 call, it's above.
Okay, so let's write it down.
Yeah, but your in the money price is determined on what you're paying.
Right. So then number two is just going back to trying to piece it back to the original question, because I understand the reasoning of why I would buy an $18 call in a few weeks if it was at 20, but what calculate? How do I calculate that within my head, or use a resource, or
wait, say that again. You want to go back?
So
and say
if it's $20 and I want to get a call for 18, because that's clearly not going up, but I understand the reasoning behind why you would do that, because it's going to be different. Price and all that. How do you decide it?
Okay, there's an equation that you would run. This is the idea of how. So if you were going to buy, if you're going to buy an $18 call option, right, and the price is at $20, a majority, if not a good chunk of the appreciation for that option has been, like people really want that call option, right? Does that make sense? Like the price is at $20 and that thing is at 18. They really wanted that. They at like $18, they really wanted it. At 18.05, they really wanted it 5 cents more. At 18.10, they wanted it 10 cents more. They want it. They want it. It's in the money. It's going to be, that's on the projection. If you're directionally trading the option, that it's going to remain in the money, right? That's what I'm saying. Like your strategic value, your way of trading. If you're buying,
saying it clear, because I understand the reasoning and everything about every aspect of why I would do it, but I don't know how to calculate why the fuck.
Yeah, this is what I'm getting into. So the calculation, let's say the 18 is up 100%, right? And a majority of that appreciation was on the last end. If it's an $18 call option at $19, it was only up 40%. Does that make sense? And now at $20, it's up 100%. So it gains 60% between 19 and 20, and only 40% between 18 and 19.
Never had that light bulb go off in my head before that. That's how decay and everything works, where if you're making the majority of that move towards the end, closer to the expiration or closer towards the beginning, that's having an effect on the reward.
Exactly. If for instance, if the percentage that it's in, it's kind of, I talked about this a little bit today. If the percentage that it's increasing is also increasing as the price is increasing, guess what? It's more likely that the price, they're projecting that the price is going to go higher, right? If people want to buy at $19, they wanted to buy that contract up 40%, and at $20 they want to buy it up 100%, then oh my goodness, that's great for you, right? Because it's picking up steam essentially. The option is still attractive. It's more attractive even at $20 or $19. It's even more attractive. Does that make sense? It's increasing in attractiveness. That increasement in attractiveness, it relates to appreciation, right? If the option that you're in is more attractive, that is going to equate to more money coming into your pocket, appreciation, right?
Definitely.
So there's equations many different equations that people use depending on the strategy that they're trying to see to determine which options they're going to buy. For instance, like what I try to do, it's really hard to explain, but like if I see an option, like let's say for instance, we're just going to be very simplistic here. We're going to look at SPY, right? So SPY kind of moves it's slow. It's a little bit more volatile now. Don't get me wrong, but it's pretty slow. It's a big market cap. It moves in one direction for a good period of time. It moves pretty predictably. So it's a big market cap. It's heavy. It's a big floater, right? So the options on it are going to reflect that. You're more than likely not going to get a 3,000% appreciation on a SPY, call or put. I mean, don't get me wrong, that infinity fucking put that we see there in the chat is absolutely amazing. But that's what you're going to get for instance, on a daily time frame. If you're going to play something like that, your reward is going to be huge, right? It's going to be huge. If you bought that in the morning, it's a 278 call in the morning, and the price is at 280, and it goes down, it's sliding on down to 279.20, 278, 875, and people still want to buy that 278 put, and the contract is going to expire in 4 freaking hours. That means that there's heavy downside pressure. There's sellers coming in hot, man, and they're still selling it. Somebody's going to pay a premium on that contract. So he sold his premium on that contract. He said, dude, I know I'm in a rocking position. This thing is looking fantastic. You want to buy it for 30% more than what I paid for it? Here you go. You got 4 hours left. I wish you the best of luck. if SPY goes from, if he buys that SPY put, if the person who bought that SPY put from him at $4,800, if SPY then dips even further, now his contract is worth $4,900, $5,000, $5,100. But this is where the scaling system and the calculation comes into play. So let's say we were at 280, right? We don't know, or we don't really know what he bought it at. But let's just say it was at 280, and he bought a SPY 278 put for 38. So he paid 38 cents, for whatever. He bought 138. He paid $3.85, right? So he paid $3.85, 100 of them, or what did he get? 10 contracts there, I guess, or he paid 38.5. No, he got 10 contracts. So he buys those puts at 280, right? It goes down to 290, and the price goes up, whatever that is, 27%. So he thought that the premium on that 27%, 7% is going to be greater than the premium that he would have saw on it going to 278, from 279 to 278. Does that kind of make sense? Like, he thinks that the chances of it going to from 279 to 278 are less. So he's willing to take the 27% premium that he's made instead of taking whatever that may potentially another 27% premium, or maybe even more if it's gaining bearish momentum, it's gaining seller speed, right? If people are more interested in that contract, they're going to continue to charge a premium for it, and the spread on the contract will continue to spread upwards. It kind of making sense now?
Yeah, I think you're making sense. And everyone here, we all, even if it's not options, we all just want to be able to dumb it down to a certain point. And it's so hard. Like, when I was asking Frank that, like, we both knew what each other meant, but sometimes it's hard to get to it. So we just gotta try to get to it and just get to the applicable part of it. Like, it's important to, like, understand the background, the definitions, all that, but being able to apply is a really big thing. So that's why we're really lucky to have, like, a great team with, like, Frank and everyone like that, where we could just try to talk about it.
There's so much. The reason why this is so good is because they're taking that it's almost impossible for a single individual to see everything. You would have to be the all-foreseer. You would have to be the guy who sees it all. Even I don't see it all, and I could spend 23 hours and 57 minutes standing in front of my computer staring at it, and I still get frustrated because I missed a move. So, like, there's no way to see it all. That's why you look at, you use people's, what they're able to see, what you're able to see. You draw a comparative analysis. You see what's, holding up to be truth, valid, what's not being valid, and you go from there, and you do value like that.
Definitely.
But so, like, the thing with options, though, so like I said, there's a lot of different strategies with options. If you're taking a super aggressive approach, you might buy something that's going to end today, tomorrow, the next day, a week, and it might be something extreme. You might get something like, you might think that there's going to be merger news, or, like, something crazy going on in a stock. It's essentially a hedged bet towards the future, right? Like, for instance, like VSAR, for instance. VSAR is not really a great, not a phenomenal stock. It's not a pharmaceutical stock that's been exploding. It jumped off a fucking cliff. It's been consolidating because they haven't done shit with their money. They got a pipeline they haven't done shit with. So it's literally just sitting in the gutter. It's got, not great sentiment. So the call options on it would have been really, really cheap because nobody's really expecting a great move. But would they be as cheap? It's not like it hasn't been up there. You know what I'm saying? Like, it dropped down from those levels. So unlike something like maybe, that has been climbing up to, hasn't been above the price that it's currently at, it's just climbing up there, those call options are going to be much, 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 much less expensive because they're not expecting the price to go up there. So you're not going to pay a premium on that. But on something like VSAR, they're not going to be as expensive because people, you think that $5 is unlikely? Well, it's been to 20. It's not that unlikely. And that, it's a possibility. That likelihood, that statistic, that probability of that happening is calculated into the price of the what you're paying. So if, for instance, you're looking at, my favorite word, deviations, right? So if you're looking at a call option on VSAR, for instance, I'm just going to pull something up, and I'm going to use a very general, very easy to follow along here. Okay, ready? So I look at VSAR. I'm going to pull up December 21st, and I'm going to say a $5 call option and a $6 call option. So I look at fours. I say, so we're on VSAR December 21st call options, guys. You can look on your Robinhood. I'm looking on Robinhood, honestly. I'm not even pulling up my shit. So a $3 call option is 50 cents, right? So $3 is pretty. I'd say that's pretty. If you ask me, Frank, do you think that BZR could go to $3? I'd say, yeah, it could definitely go to $3. I think that's pretty fair assumption based on its trajectory, the trend that it showed today, holding above the 50. Everything that I justify what I'm trading, right? So you can see that reflects in the price. It's up 78%, right? Right there. So you're paying, and that, we don't know how accurate these prices are, so I'm just saying what the Robinhood is paying. But people were paying 50 cents for that. They were paying 50 cents for the possibility. It's up 78%. So they're assuming that 78% risk. They're assuming that 78% risk because it's value. They're valuing that 78% risk that they're assuming at 50 cents. So they're willing to take that. To break even, they need $3.50. They're not going to break even at $3, right? Because they're already assuming 78% risk. They have to make that. They have to make up that extra leeway that the guy is leaving them there. They're paying a premium on that contract. That's why I'm saying you wouldn't necessarily, you don't really want to buy stuff that's already in the money because a lot of that good chunky premium is already there. And that's what's going to be displayed in the price. That's why you see a drastic difference between the price of a $3 call option and a $4 call option, right? We go from 50 cents from a $3 call option, which is very likely in my eyes, 78%, to break even, 51%. Now you go to a $4 call option, it's only 18 cents. It's only up 34% today. Because if you ask me if it's going to go to $4, I'd say, I don't know. $3 is probably more likely. $4 is not that, a little bit more like, a little bit less likely. And it's reflected in the price. But how much is it reflected in the price? I'm getting it for 60% cheaper, right? So that's the deviation. 32 cents is the deviation there between the $3 and the $4. So then I go back and I look at the $2 contract and say, what do people buy the $2 call contracts for the same time? Because when you're drawing these, that's a very important thing that I should say right now. When you're making these equations, they all have to be in the same time. You're trying to see the best deal for the time period that you've selected. You can't say that if you're going to try to determine what's the best deal overall between different time periods, then you need to do an aggregate average between all of them. In other words, you have to find the average within this time frame. What you should be paying for this time frame. Then you go to the next time frame. You get that number, and then you average all those, and that's very complex, and that's not really something that we're going to get into. But we're just looking at the specific time frame. We're trading this one time frame. So the deviation in price, right? So for the $2 calls, they're paying 65 cents. For the $3 calls, they're paying 50 cents. You can see the premium there, right? You can see how a lot of that premium has been made. Because if they're paying 65 cents for the $2 ones, guess what? The $2 ones are in the freaking money, dude. The share price closed at whatever, $2.15 or $2.20, and then it ripped up after hours at $2.40. You should be paying. You're paying top dollar for those, dude. They're at $2. Look at the $1 calls. The $1 calls are double that, right? So if you're using that scaling system, the $1 calls are double that. The $3 calls are not double that. You know what I'm saying? The $3 calls are almost the same, are within the same 25 percentile of price there. 50 cents versus 65 cents. Whereas you're getting 65 cents versus $1.23, right? Is everybody kind of following with me? Does this make any sense?
Yeah, definitely. And you want to whose question was it? We were just going, right? That wasn't Itchel's question, right?
No, this is. I'm just.
All right. So last time when we did the swing chat, I personally felt like we were just having no flow. So let's just start going back and just as we go, just keep knocking out the first questions we had. So I'll repost the picture for us, and as you go, just keep saying whatever as you're doing. But we just don't want to miss everyone's questions. We did that, and I was getting so frustrated.
The current daily swing display option value is normal. Okay, this is a great question. I like this question. Good job, Icol, however you pronounce that. So this is a good question. This is when I say you have to take all of the things into consideration, right? So would that be happening on a daily basis in more stable conditions? Absolutely not, right? In more stable conditions, you're going to see much more. You're not going to see these types of appreciations in call prices because the volatility isn't going to be there. You know what I'm saying? When you're having moves like this, when you're having SPY, for instance, SPY, I remember days a couple of years ago, or maybe even last year, when I wake up and I'd be happy if SPY moved a quarter of a point, dude. Now I wake up some days and I say, is SPY going to move 3 points today? You don't think that the price of the prices of these options are reflective of that? Of course they fucking are, dude. Of course they are. You'd be stupid to think if they aren't, because it's uncertainty, right? You're paying for that uncertainty. That's crazy. Of course it is. Of course it is. And the more stable conditions, the more stable market conditions guess what? Prices of options will decrease, right? They'll go down because market conditions are stable. Less needs to hedge. There's less needs to hedge. We don't need to hedge. They don't need to. You're not going to get more. You're not going to get more interest into options, right? If market conditions are stable, because institutions and retail buyers can just buy stocks and write up the appreciation. They have no need for. They don't need options. They don't need the option. If they do, they're buying puts and they're buying 1% or 2% of their appreciation on their gains, or to protect their gains on their appreciation. And that's not going to increase. That's not going to give you a 50% gainer in a put, in a put option. It's not like everybody at one point is going to be like, oh my god, we need to hedge this. If it does, guess what? You're seeing volatility, and that's not the stable market conditions we're talking about. So that's a phenomenal question. Did I answer that question? You want a little bit more? Like how? Give me another. Yes, that was good, or no, that wasn't good.
It's up to you, Richo.
I mean, dude, I guess okay. Yeah, so definitely. You have to take all those things into consideration, guys. All of these things, they all go hand in hand. It's all money flow. Money flow. Money wants to continue to make money, and money wants to remain in the position that's more likely to make money, to be in an appreciating position. That's where a majority of the money is going to be. 50% were the sweater gaining anyone see. Yeah, I'm getting it's going to end up when the market on SPY. Wait, so in other words, this 50% return of bananas on SPY I'm getting is going to end when the market stabilizes one way. Yeah, if the market stabilizes, you have to think to yourself, ask yourself this question. And I mean, this should answer your question, but ask yourself this question. Sit there and say, in what God's name forsaken world, I mean, like, what would the world have to look like to stabilize market conditions right now? Trump would have to go to this meeting. He would have to shake hands with North Korea. They would then have to ship all of their nuclear weapons outside of North Korea. Like, the world would have to go into absolute world peace. And everybody who hates Trump, they would have to come out and say, we love Trump. And everybody would have to hop on the same bandwagon. And, and that would stabilize market conditions. And do you think that that's going to happen anytime soon? Probably not. You probably got another solid 3 to 4 years of unsteady market conditions, in my opinion.
I mean, Trump became our president.
Yeah.
Okay.
Volatility is phenomenal for business, dude. Everybody loves volatility. Volatility is where money is being made, guys. Why do you think that volume precedes price? Why do you think that happens? Because when volume is coming in, money is influx, right? Which means that you're getting more people buying, or more speculators, right? We're looking at this money saying, oh my god, it's hitting a volume scanner. Oh my god, people are buying this thing. That creates volatility. More people coming in buying it. Volatility. And then you have somebody say, oh, it's 252, I'll buy that. And then they say, oh, it's 253, I'll buy that. Oh, that's 254, I'll buy that. That's volatility. The more that there is, the more hunger there is. Like fucking Axon, for instance. When Axon was running, gapping up 5-10 cents to the upside, volatility was at an all-time high. People didn't give a fuck at what they were paying for Axon. They wanted to be in that shit at any given price. That's high volatility. That's money. That's where money is being made. High volume. High volume is where money is. Yeah, everybody loves choppy market conditions. Do you think that big institutions are not making guapo right now, dude? Of course they are. It doesn't necessarily mean that they don't want the market to explode. It's not like they wouldn't make a ton of money if the market explodes. Sure, they would. But if they can have 2 or 3 point swings in SPY and suck in, another 10, 15 billion dollars of retail money every day, why wouldn't they? They'll chop it up. They'll make you a nice little chopped salad. And then right when you're enjoying it, they'll tell you that it was fucking made out of horse meat or some shit. I don't know. What's the next question? Help me, Ziggy.
Okay, so go 2 pictures up to Pursuit of Happiness, where it says if it's a $18 call, stock price 18.20. I'm gonna read through that one.
Wait, I'm really gonna.
To post the questions for you until you say you're ready, because I'm just gonna repost it. Now go to the bottom.
Yeah, repost it. Yeah, repost it.
Because I started confusing myself too.
Okay, if it's $18 call, stock price is 18.20. Buying a call for 17 is paying way more to see the stock price go up, like 10 cents to break even, versus doing an $18.05 call, okay, with a break-even price of like 19. You pay way more because of the scale of volatility is much lower call.
Yeah, it's absolutely right. I'll answer that because that's what you just explained to me. I was so mind fucked by that before.
Please, I'm gonna grab some water. But
yes,
this is very. I just explained this.
Yeah, in Pursuit of Happiness, you kind of elaborated on it better than I was able to. That's why I needed him to like re-go over it, because I couldn't have even pieced it together in my head to the point of where you literally understood it, where you're paying more because the scale of profit or volatility is much less. For you would earn more money because you paid much more, right? So I imagine are others in here where I wasn't even at that point, and I didn't really need to be to understand it and understand your question, because if anyone else is confused by that concept, I know it's something that many people are confused about beyond one of us. So he was saying buy a call, which is bullish, at a rate that's lower than what it already is at. So when I first started, I was like, I don't understand. Like, I'm clearly not bullish then, so you'd be shorting it. And that's really not what it is. And that was the great explanation by Pursuit of Happiness. The other one. Next one.
The thing that you need to. So another thing to add on to the Pursuit of Happiness, when you're doing something like this, so this is why. So you're trying to. Okay, this kind of goes back into value investing, but you're trying to determine the best deal, right? You're trying to determine the best deal. So if you see that the $18, I'm trying to I gotta keep. It's hard for me to keep track of it. It's freaking in my mind like this, but. If it's an $18 call, stock price is 18.20, buying a call for 17. Okay, so the 17, like I said, has gotten a good amount of appreciation, right? There's a good amount of attraction there. We already know that the 17 call is in the money, and now it's way in the money. So there's a lot of security there, right? But that's one way of looking at it. That's one perspective, saying that there's a lot of security there. It's already above. It's way above 17.20. But when you're looking at security on the other side of the fence is, guess what? Risk, right? Because the person who bought that $17 call has already made that 75%. So you're looking at that 75%, and you're saying, security for me. This is already 75% of the money. There's a good chance that this is going to continue to go 80% of the money, 90% of the money, 100% of the money, and so on, right? Because it's very, if you're trading volatility, it's directional, and you're getting good price action on the stock, it's going to continue to rise. The reason why you need to be a value investor is because let's say for instance, you buy this $17 call, right? And it goes up, you break even on it because it goes up a little bit and you break even on it. And then that amount of money that like you said, you pay much more. That amount of money that you would have made on that $17 call option going up in that amount of appreciation, like that 10-15 cents, 10-15% that it went up, and you paid the premium, the equal dollar amount per ratio, versus buying, like, let's say an 18.5 call and then experiencing maybe a 10% appreciation there. The amount of appreciation, that 10%, like you could be making 10% on both ways, right? But on the call that's already in the money, you're paying a lot of extra on the premium. So you're not going to make as much money. A lot of that money has already been made. So that's kind of what I'm just trying to that's what you said, but I'm just trying to cap it up. Right.
Okay. So, I didn't say it on voice, but everyone just hold off on any new questions. Let's catch up to the old ones, and then everyone can ask questions to add on to that one, just because it gets a little bit hard when we were all talking, and there's nothing wrong with it, but it's better to just not fall behind. Helps us all. Okay.
And I really want to stress, guys, a trading strategy, right? I mean, you all know, because there's people who trade options and they do exactly what we're just talking about, like buy in the money calls, and they sell them for a little bit more in the money for their call. They sell the premium a little bit more. Like, that's a strategy. That's a strategy that, like, they're using price prediction, the amount of volatility, the amount of volume that they're seeing. They're projecting a higher price in the short term. So they don't care. Like, they don't necessarily care that they're assuming the 75% risk and appreciation, because they know, they have a good idea that the stock price is going to go up. So they're just making that 10 or 15%. For them, it seems like sure money. It seems like guaranteed money. That's a strategy. But that's only under the conditions that the person who's doing that made the proper analysis and is sound in their analysis and is right? If the stock price does continue to go up, you go up to 18.15, you still get the 10, 15% of appreciation. So that's just kind of what I'm just want to cap on that. So what's the next question? Is it best near the closing bell so that tomorrow? Okay, this is a great question.
And Grayson answered it a little bit. If you want to add your thoughts upon his, I'd post second.
Yeah, like so this is a great question, and everybody's always asking. Like, this is a very common question in the options world, and a lot of it has to do with liquidity, right? Liquidity and the premium that you're paying on the option itself. The option itself, the pricing on the option, lies within a range, right? It's always within a range. It's within the lowest price that somebody is willing to sell the option for versus the highest price somebody is willing to sell the option for. So where you're buying it in within that range is determined on the amount of open interest, the amount of volatility that you're seeing at that given time. So so if you're seeing a lot of, this is why it's kind of a tricky question. Do you buy it near the closing bell so that tomorrow, if the stock is tanking, you get out and not lose your face? So, like he's saying in this instance, you buy the options near the closing bell so that tomorrow, when the stock tanks, you're not losing on your premium. And the ideology is behind that is that, oh, I'm gonna save a ton of money, right? I'm gonna save myself from all that, all that depreciation that I think the stock is gonna suffer. I'm not gonna experience it. And that's where the theta is gonna crush you. The time you're giving up, like that ending contract, that ending day for that contract, not for that specific contract because you're able to buy it and use it into the next day, but for the contract that ended that day, people were trading that, right? They stole a lot of the money that you think that you're going to be making has been made by the people who played the contract ending today, starting today, ended today, or started, whatever that's ending today. All those contracts that are ending today are stealing your reward that you think that you're going to be making from doing it. So, in my opinion, it could go vice versa, right? Because like it's so unpredictable. I like to take control of my trades. I would never buy in options into the close. I would always buy them in the morning when you can accurately gauge the amount of volume and volatility that you're currently seeing, especially if you're day trading. If you're not day trading, you're buying a month, you're buying a month or 2 months out of the into the way, then you're just like, okay, you're penny pinching basically on the premium. Am I going to pay 70 cents? Am I going to pay 75 cents? It's not really, it's not really going to make a difference for the type of trading strategy that you're using because you think that's going to go to $1.50. So if it goes to $1.50, what's the difference if it makes 70 cents or 75 cents? It's only 5 cents. You're penny pinching, and that's the premium that you're going to be able to get is based on the volatility and the open interest on that particular option. For instance, if you find somebody, and this happens very often, and this is where you see people make a lot of money. Somebody will have an option, like let's say, for instance, like Sprint, for instance. I bought $7. I have the $7 call options for Sprint, right? And I didn't know that there was going to be merger news. I had no idea. So for me, all I saw was Sprint in a gradual decline. And I was like, oh my God, I got to get out of these Sprint calls. So I was selling them all the way down at like, let's say 1 cent contract at the lowest I could sell them for. Absolute dog shit. The person who did that, the person who gave up 10 cents, who wanted to make 10 cents on those, it's very unlikely that you'll find this. But when you do, you can make a lot of money, right? Because the person who gives up those 10 contracts for 10 cents, now the person, if you had enough time, it's very unlikely that you're going to find it for that cheap. Money equates to time. The more time, the more money always. Money equates to time. So it's unlikely that you're going to find them this cheap. But if you did, you find somebody who's like stuck in a limited liquidity issue where there's not enough open interest in their call option or their put option, and they're struggling to sell it. You get the bottom end of the premium, right? If you do that, guess what? All you can do is make money. Within that time frame, mind you, within that time frame, always. All you can do is make money. If you buy it for a penny and you got another 3 months, who cares? Let it go. You know what I mean? You got 3 months. Whatever happens in that 3 months. Turns out Sprint gets merger news and shoots up to $7. That 1 penny stock option, because of the volatility and volume that came in that nobody could project or suspect, or maybe some very smart people, you know, like, they're going to make tons of money. It's going to go up. You know, now it's not worth a penny. Now they're worth $1.23 because stock, you know, Sprint is at $7.50 or whatever the stock price is at. So there's a lot of money to be made if you find somebody who's taking the low end of that premium, who doesn't believe in their put.
So I think this was Isho's next question, although it probably doesn't require a long answer, but I do just want to keep going with everyone's answers because I find this really helpful for myself at least.
Well, I answered this kind of. He said
okay.
The return bonanza, is it going to end when the market stays?
Right, I know that you did pretty much answer it, but I did just want to make sure everyone's question can answer just so many.
I'll answer real quick. It's not that it's going to end. They're just going to become less. It's not going to end. It's just going to become less frequent. With more volatility comes more of these bigger runners. Strategy question. For a small account, buy options at the end of the day for swing. Buy options early and plan to day trade. Okay, this is what I'm saying. Okay, so he's saying if small account, buy options at the end of the day for swings. So the reason why you could use a small account, a little bit of capital to buy options at the end of the day is because people are doing what? They're panicking on their premium, right? They're saying, "Oh my God, I don't want to give up another day of theta. I'm not going to lose another day slot of time frame on this contract. What it could cost me?" And they're trying to slide out on the contract. So they're selling at the bottom. They're selling at the bottom of the bottom of the channel. If you're trading a stock, it's the same thing. They're selling at the bottom of the channel. So if you buy it at the bottom of the channel and then you swing into the next day, and the next day the stock isn't nearly as bad as it was that day, the sentiment is a little bit okay. It's a little bit better. Yeah, you put yourself in a great position, and that's phenomenal. But if you don't have a bad stop, guess what? You just bought a piece of shit. If you don't have a good stop, you just bought a piece of shit that's going to slide into the abyss. Buy options. So that's one strategy, right? Buy options early and plan to day trade. So that's another strategy. A lot of people do that very often. That's one of the most common, right? Because it's very easy to gauge things, to take control of your trade when you have a defined amount of time. When the market opens, when the pre-market opens at 6 o'clock in the morning, 6 a.m., you look at the volume. The volume is there. It's definitive. You know what it is. You can touch it. You can feel it. You know what the value is. You can calculate it. Then and then to close is one section of time. That's a pretty stable section of time. You can moderate that one as a block of time. Just like a day, it's a daily candle, right? We look at a daily candle to see how the day was. You look at that as one block of time. So it's much easier to look at it one block at a time, one candle at a time, than to look at 10 or 15 candles and try to predict the next candle. So that's that. Buy a straddle and wait for confirmation before moving. Okay, so this is another strategy. A straddle is very simply this. You go both ways. You buy a call, you buy a put, you ride it in both directions, you wait for confirmation for the break in either direction. This is called an indirect trade. An indirect trade means that you don't give you don't care which way it goes. You don't really care. It can go up, it can go down. All you know is that you want to make money on the move, right? And what it does, you want it to go hard in that direction. So that's basically what that is. That's a very, very common strategy. And this is using support and resistances, right? Because if you're straddling a position, you're doing it because it does a formation like a sideways, descending, a sideways pendant, if you will. It's pendanting to the side, so you can't tell if it's going to break up or break down. So you build a straddle position and you wait for confirmation. It breaks up, sell. You get rid of your short position, and you just stay long and you ride in that direction. So what works better for a small account is very clear. You're not going to be able to do a straddle. I wouldn't recommend, because for a small account, that means that you'd have to split up your money. And with a small account, you want to get as much leverage as possible. So no straddling with a small account. Get away with that. And if you were to do it, you'd have to do it very small, like very risky and very small prices. So you don't want to do that. And limited liquidity. So you don't want to do that. Buy options early and plan to day trade. With a small account, that's very hard to do. You're going to make one trade a day. You know what I mean? And you better make sure that it's a very well-calculated one that's going to provide you with the gain and appreciation that you so require based upon your capital. So that's an option. It's not one that I would do, but it's an option. If I had a small account, I'd buy options at the end of the day for swings. Yeah, I would do that. Or I'd do what what I explained to you with Sprint. Find those stocks that are so beaten up, so in the absolute like shithole, like that things could not get any more worse. So people are selling those contracts at dirt sheet premium. And even if you buy them, if you have like, let's say you have a $5 account, this may sound kind of crazy, but you have a $5 account and you're on Robinhood, so you have no fee, no fees, if any. So you got $5 on your Robinhood. You buy 5 contracts for a penny or 2 pennies on something like Sprint for $9 at the end of next year. Fuck it, YOLO it. You know what I mean? If they come out with a fucking more merger news that they're giving up valuation of their company, you make more money. It's a big play, and then you're only giving up 15 cents. 5 cents rather. You buy one cent, you buy a couple for 3 cents, you buy a couple for 2 cents. Whatever you're gonna do, and you do it like that. You look for the older oversold tile positions, and you buy a couple calls, or you look for stocks that are overinflated as fuck. Like Axon at 650, and you buy a put for a cent. You think that people were charging a premium on their put contracts when Axon was going up 80 cents in 5 ticks? When Axon was going up 10% a minute, do you think people were charging a premium on their call puts? No, dude. People were selling their call puts for as cheap as they could fucking get them because they want to get the shit out of them. Or people were buying up those cheap premiums so that they could fucking try to swing them. Exactly. That so you took the latter option. But that's the 2 ways to play it. That's the strategy. Let me look, because I have to look. I get confused with this because there's so many different types of trading. I guess go to refresh my. Can everybody still hear me, by the way?
Yeah, you're good, Frank.
Okay.
This is helping me so much.
Because there's a good that I know of explains this like very generally.
So did we answer all of my takeaways part of the question?
Yeah. What more questions? Like what more?
I'm just trying to stay organized. I'm gonna repost my takeaways and make sure we.
Oh, so my own specific option strategy. So me personally, I don't. When I do trade options, it's very simply to hedge. And like to give you an example, if I buy something like VSAR, like I did buy VSAR, but like I'm just giving an example. I don't mean to relate it to real life. I buy VSAR and I think this stock is really great. And I like this stock. I don't want to sell it. I like my shares, my 147 average. I don't want to give them up. You know what I mean? But at the same time, I recognize that I'm up 80% on my freaking, on my position, and that's a little ridiculous of a gain, and that I should probably consider selling some of my position. So what I would do, and like I said, I typically don't do this. I don't really like options because with options, the way that my mind works is that I have to calculate all of these percentages and come up with all the data, which I don't want to do. For me, I just trade the physical thing, and I don't need to calculate those things. I calculate much different things, much more definitive things. Yeah, so I'm looking at this VSAR right there, takeaways. So I look at VSAR, I say, well, yeah, I really don't want to sell some of my position, but I really want to make sure that I can capitalize on this VSAR position if it continues to move upwards. So let's say I'm holding 10,000 shares of VSAR. I'll sell 2,000 shares of VSAR, right? And what I've done is I've lightened my position in VSAR by 20%. So let's say I'm up $5,000. I've secured $1,000 worth of profit. So then I would probably take that $1,000 worth of profit, and I'd go here and I'd buy, some $2 calls, or if I wanted to risk the biscuit, some $2.50 calls or something like that, some $3 calls, some $4 calls, and I just spread up the $1,000 like that. And then I'm gonna feel a lot more comfortable, like that I sold some of my VSAR position, because even as the price is gonna continue, like if the price continues to go up, yay me, right? I'm gonna make money on my calls and I'm gonna make money on my VSAR shares. But if the price declines, I don't want to risk the money profits that I made on VSAR. So I'm going to be able to sell those, secure my profits, and still have a good long position on VSAR long, because I bought the puts or the calls cheap at the extremes, right? I hedged my position. I used that profit to ensure that I'm still going to make profit, that I'm still going to make my $1,000, if not more than my $1,000 back. But I typically don't do this. So that's my strategy. I use it as like a hedge to ensure that I'm going to continue to make money. That's what the game of trading is. put yourself in a position where you're going to continue to make money, always. You always want to be on the side of the fence that is making money. Like when I was talking about yesterday, with the grass is always greener on the side of the fence, the other side of the fence, you never want to be saying that. You always want to be saying, the grass on the side of this fence is so freaking lush and beautiful. I love it. What else we got?
I have a question, Frank.
So, exactly. So if you know it's going to keep going up, spend more. Okay, so it's going up and up, and it's going up and up and up. So, and you're going to spend more, right? If the volatility, if the amount of volatility that it's going up with stays consistent, like you keep on getting that amount of volatility and that amount of appreciation, then yeah, absolutely. Spend more on the fucking premium. It doesn't even matter what you spend on the premium because it's going to go up and the volatility is going to remain up with it. So the premiums are still going to increase in price. You have nothing to worry about. That's guaranteed profit. If you got a deal on those premiums, fantastic. You guys, options, what I'm talking about is trading stocks. Do you guys not understand this? Like, I'm literally just talking about trading stocks. When you're talking about a position like this, you're dip buying. You're dip buying. You know, you're dip buying, you're selling the rips. That's all you're doing. You're just doing it through options. Options give you the option. How funny is that, right?
See, the most frustrating thing for me has been, I bet there's several other people in here, it's like knowing that you're able to do the option, you just can't find those little pieces where when we're answering these questions, we're all just like, oh, like, I mean, that kind of makes a lot of sense now. Like being able to understand and piece it all together. And then Ichol said, why is it bad to buy them at the end of the day? I don't know why I would buy it at a different time of day besides for price action being differently.
Really? But well, price action being differently.
Like,
your answer is within your own answer. You know what I mean? The price action is differently because it's selling pressure because people are closing their contracts.
like,
At the end of the day.
like the stock itself.
Yeah, I mean, like, you know, and they're exactly, they're taking profits on the stock itself. Like, you know, the answers are just, they lie within what you already know. You just gotta dig them out.
Are you on the same page too? That cleared it up for you as well? Just say yes or whatever. And then next question.
Why is it bad? Oh, yeah. That's why it's bad to buy them at the end of the day.
Okay. If I missed anyone, repost your stuff, but I think we're like almost caught up. That's great. Last time we really fell behind, I'm just getting so irritated. Okay. I actually don't see any questions left. Did I get it?
Yo, Frank.
Oh, I have one more.
Oh, I just want to say one. It's always, you have to understand, came out, like, calls are always, the market is always in favor to go up. Always. Always, 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 always. You're always going to pay more, hypothetically speaking, for a call than you're going to pay more for a put. Nobody wants a stock to depreciate. Nobody wants to, no, it's not like more people make money if a stock depreciates. If they do, it's because it's a bearish stock, right? Like, that's simple. So that's very, like, of course. Calls are obviously better than puts. Unless the stock is super bearish, then fucking puts are the thing to be buying or selling if you're in a game.
So we're pretty much caught up, and then Perceived Happiness question is pretty much what I said. We could do some sort of assignment after, just go over problems or something, but if there is something you have to comment on that one. Otherwise, if someone has the question typed in, you could just ask away. No, it feels good that we actually cut up to all those. That was a lot.
You have to do your homework. You have to, because people use this data that you're gonna, like, everybody gets this data. Like, the data is provided to you by your broker, by the person that you're buying the option from, right? So it's up to the person. That's why, like, it's important that you learn it, but it's not like it's absolutely necessary to be profitable with options. And this is what I'm trying to explain to you. It comes to being a value investor. So, you know what I mean? A value investor. That's what it comes down to. And knowing how your option is being affected by things like, you know, rate of change, like time and things like that, like, is important. It's most certainly important. And there's a lot of, you know, strategies that revolve around making sure that certain criteria is met to provide the most stable trading conditions or, you know, strategy that you're implementing. Like in regular trading, just like people who buy breakout stocks or sell you know, I don't even know, below VWAP, whatever the hell you want to call it. It's the same type of thing. It's just with options. But yeah, it's important to learn it, and you know, just but it's more important. It's more important to be able to see how it affects the value of what you're trading. That's what I'm trying to say. Yeah, who has any more questions, please?
Go with your questions, and Frank, at the end, I think it would be a great idea. We all just go through. It's like we just choose even a random ticker, one we know. I don't know. I really like that mobile example. But you go through, and we'll just fucking decide on what contract we would particularly do in the situation.
Okay.
I need.
Okay.
You guys aren't done the questions. I just can't think.
I'm just gonna use a very simple example. I want to keep it simple. Let's look at JCPenney.
Okay, let's post charts for that.
All right, so whatever. You don't need to dig super deep into this, guys. Like, keep this very, very simple, right? We're looking very, very simple. What do you got? The yearly here? Perfect. So just keep this very, very simple. You don't gotta overthink this shit, dude. Like, this is very. You need to start with the general idea, okay? So you look at JCPenney and you say, JCPenney, what are you doing this year, bud? How you doing this year? How we looking? Okay? So we look at JCPenney, come into the year, we come off of holiday sales. Looking good, okay? Stock comes up, stock comes down, tests below the 50, rallies above, what is that, the 50? Yeah. Tests below the 50, rallies above the 50, breaks above the 200, can't sustain above the 200, gets sold off, breaks below the 50, comes down below the 50, goes back up, tests the 50, 50 becomes resistance, and now we have a confirmed bearish stock, right? If you're trading JCPenney, you see this come up and you see this formation, it come up and confirm the 50 as resistance, your boy Frank would have been short the fuck out of JCPenney when he saw this. So, bearish stock, sentiment, you know, so into the beginning of the year, we were okay. We're happy with JCPenney. We're looking good. It's not the most bullish formation, right? And this is what you need to understand. Like, it all comes together. So the important thing to look at here is the amount of dips and the amount of rips, right? So you can kind of see when we come up in this beginning, try to refrain from posting anything in the chart just so we can kind of keep an eye on this chart that we have posted here. But you can kind of see, like, in the beginning of the year, when we're grinding up, we grind up to $4 here, we get rejected off the 200, and then we come back down. But we come down a lot, right? If this was a healthy stock, you necessarily wouldn't come down. You don't run up. You're not going to run up from, you know, what is that, 282. You're going to run up to $4, which is $1.20, and then you're going to come down from $4 to $3.30. You're going to run up $1.20 and then do a 50% correction. Like, that's not really a strong stock to me, right? A strong stock to me does less than 25% correction or retracement. Really, a super strong stock that I want to be trading in does less than a 5% fucking retracement or 2% retracement if I'm day trading. So this is what we're looking at. So that's a huge, huge, huge correction, right? We lost half of our move there. Then we squeeze back over, we break back over the 200, which is good, but the 200 is lower, right? So it's not like the same resistance. It's not like we broke over the same mark. The 200 is coming down. We have a downtrend forming here. The 200 is sloping down. We broke over this sloping 200 downtrend, but our inability to sustain it creates and confirms that we're going in. It creates a downtrend, and then the downtrend is confirmed by it getting rejected off of a lower trend line, such as the 50, which we all can see clearly, right? So we're looking at this stock, we're saying sentiment on this stock is not that hot. Because if sentiment is on this stock is hot, we wouldn't have dipped from $4.20 or from $4 to $3.35. We would have dipped from $4 to $3.80, and we would have ripped up from $3.80 to $4.20, and then we would have came down. We would have confirmed $4. You know, like, that's a strong stock. This stock isn't that strong, and now we're clearly in a downtrend, right? So we're in a downtrend. We've confirmed a bearish downtrend, and the stock price is still plummeting, guys. We go up to test the 50. We don't even make it to the 50. The 50 slams down. Now we come back up. We barely touch it. We form this, like, you know, formation, this fake hammer formation here. Get rejected off the 50, and then boom, get rejected back down. Get gap back down, right? So that's, like, for me, I would cover my short this gap down tells me that the bearish trend is coming to a conclusion. You know what I mean? It is like getting a gap down after that much depreciation is like almost like it's a long squeeze essentially. You're trying to get as much money as you can out of this. So now, stock price plummets. We form a new low on the yearly rather, and we're down at 220. Now at 220, your risk reward on this stock is phenomenal, right? Based upon its yearly move here. So we're looking at JCPenney and we're saying, wow, this thing is getting beaten up. How much beaten up has it really gotten? Okay, so that's like how is it really worth this much depreciation? What's happened to JCPenney in the past 6 to 8 months? They would deserve such a depreciation, almost a 50% from highs to lows. So now we're going to look at the options here. I don't really want to look at all of those because I really only want to look at very relevant. So let's just pull up a basic Robinhood.
Yeah, can I just be frank real quick, not even butting in, but what kind of program is the universal way? Because every time one of these pictures gets posted, it's a different format, and it goes in one eye out the other. I don't even pay attention. I don't even know what I'm looking at because I need to look at something consistent. Does everyone use options profit calculator? Or?
Yeah, but I would just, you're gonna get different.
I like consistency.
Stay consistent and be. I like Robinhood because it's simple, right? You could very easily see with there's not much mumbo jumbo on Robinhood.
Right. No, I agree.
So for very basic options trading, everybody could just see Robinhood, what Robinhood is trading at, and the spreads are shit. These aren't accurate prices, guys. So don't go trading this on Monday, just because Frank said, "Oh my god." But we're just looking at the pricing, right? So now we're looking at the JCPenney stock. We were looking good in the beginning of the year, not so good, but we're looking okay. And then we looked really bad, and now we looked really, really bad, and now we're looking to turn up. So that's what everybody's banking on, right? We're saying, is JCPenney going to reverse here? Is JCPenney worth more than $2.80? And we're about to break over the 50. This could be a great reversal play. I've been calling JCPenney for a while. But so now we understand the overall sentiment of the stock, right? We kind of have an idea of where we're at. We got beat up. We were looking good. We got beat up. We got super beat up, and now we're looking to reverse, and we're at the first turning sign for the reversal above the 50. We're going to call that we're going for the bronze medal. We're going for the bronze medal. And that's going to be reflected in the call pricing, right? So let's go, back into the, into the Robinhood here, and you can see how the pricing is being affected. So a $2.50 call is up 23% today, and the price went up 2.17%. So it's not much. We didn't really go up much in price, but the option for a 250 call did very, very well. And the reason being is because if we're looking at the June 15th there, right? Yeah, the June 15th. How much days we got? We got another almost full week of trading, right? There's a lot of time there. So if we're showing this much of a bullish trend, a possible reversal here, these 250 calls are actually still pretty attractive, 23%. Look at the $2 calls; they're only up 10%, right? Pretty good. If you look at the $3 calls, they're up 12.5% today. So that's I'm trying to gauge them, right? I'm trying to say I'm trying to value invest here. I'm trying to say what's a good bargain for me? Should I spend the extra 30 cents and get the $2.05 calls because I have extra protection there because they're already in the money? Or do I just risk the 5 cents and do I buy the $3 calls? Or do I just go YOLO and I buy the 3.5 calls for 1 cent, right? And that really is all dependent on your strategy. If your strategy is a small account and you're trying to leverage it, you'd see if there's open interest on the 3.5, which I guarantee you there isn't before, because the price wouldn't be at a cent. But if there were, and you were able to buy them at a penny, you'd be snagging those up. You'd be snagging those up all day. Because you got 50 cents. If you could snag 50 of those contracts and this thing goes to $3.50, $4, you're going to make bank, right? If you got a little bit more money, you're going to buy the 5 cent ones. And you probably, you'll probably do okay. You're at 282. You got your next resistance maybe around the 290 mark. And you break over and you're in 3 and you're in the money, right? So 8.68, they're giving you the percentage there. To break even at 8.16%. You know what I'm saying? So you're looking at how much it takes. If we're going to draw a direct ratio, this is a bad example. We obviously not getting an accurate spread, but if you do the $3.50 calls at 1 cent, and you need 24% to break even, but it's only 1 cent, and you look at the $3 calls and you need 8% to break even, but it's only 5 cents. So then you ask yourself, do I want, like, the more likely scenario is that this goes up 8%, right? Of course. It's more likely that a stock goes up 8% than it goes up 24%. That's just, of course, right? That's just logic. So you're going to pay 4 times as much for that likelihood, that 1/3 likelihood, the 1/3 ratio. It's only 8%, 1/3 of 24%, but you're going to pay 4 times as much. Do you understand what I'm saying? And this is where you be drawing ratios. If you were day trading, you'd be drawing these ratios direct, and you'd be trading the spreads and the premiums based on how sentiment is changing. And I'm gonna, this is an example. This is probably not the best example because you can see how this is not good for the spreads and the pricing isn't that great. So let's look at SPY, something like SPY. So on SPY is a great thing to be day trading options because sentiment on SPY has been shifting very drastically, right? So if you get let's look at SPY June 13th. Today, if you're playing a SPY June 13th on today for SPY, you got another, 5 days or a couple trading days left? I don't even know. What day is today? The 8th, the 9th? So you got 1, 2, 3, 4. You got next week. You got next week of trading left, right? So you're paying for 5 days. You're paying for a 5-day slot of opportunity for you to make money. So let's say, for instance, you buy. Why am I in puts? What the fuck? So you buy a 278.5 call today. You bought a 278.5 call today at 85 cents. Now you bought it at 85 cents, and now on Robinhood it's $1. So what that means is that when you bought it, the sentiment of SPY going up to 278.5 was much less than it is now. And that is reflected by a 15-cent increase in price on the call option. Does that make sense? Everybody with me?
I'm with you, but I want to hear from other people to say that they hear you. We got a bunch of people here. Let's all be on the same page.
So if SPY was at 278, SPY was at 2. Now it's selling at $1, right? So that means that it's more attractive. We're going to pay more for it, so which means that it's more likely to happen. That's what we're trying to get at this. We're trying to dig deep. We're trying to figure out what we're doing here, right? So it went up 15 cents, and let's say if the price was at 278, and now we're at 278.42. So we're really close to our target here, our call option at 278.5, and we've gotten 15 cent appreciation, 15% if you're going to do it on the 85 on the dollar rather, right? So now you're looking and you're saying, well, what about the 279s? How's the opportunity looking at the 279s? Because we're trying to gauge, right? Trying to figure out what's a good buy. Where am I going to make the most money? I can make 10% on the 278.5s. What if I could have made 15 or 20% on the 279s? Because the 279s at the time seemed much less likely. But now they don't seem as unlikely. Now they seem like they're likely, and 278.5 seems extremely likely. So the premium of the price of the contract reflects that, right? Make sense?
Yes, sir.
Everybody's head's spinning.
Spinning in a good way for me.
But I mean, it's just it's pretty. Don't you
It's not that hard. It's not that hard. Even most of people, I never thought it was, but it's piecing it.
It's not hard. It's not hard. What's hard is to do it. To make money at this day trading, to be doing call options on a day-to-day basis, you have to be good. You have to figure out where sentiment is changing, where sentiment is shifting, where sentiment is remaining the same, where sentiment is going to drive prices higher, where sentiment is going to drive prices lower, where the environment is going to allow prices to. You have to be good. But the more time, the less good you have to be. The more time, the more With the more time, the more of a gamble it becomes, really. Because nobody can project what's going to happen in 6 to 8 months. Or, they can project what's going to happen in 2 to 3 weeks much better than they can project what's going to happen in 1 to 2 months, or 6 to 8 months, 1 year to 2 years, or 3 years to 5 years, respectively, right? And the word respectively means because we're drawing a comparison between different samples of data that are not the same. Yeah, exactly, guys, exactly. The strike may be in the money, but if you paid a fortune if you paid above if you overpaid on the premium, if you bought when speculation was super, super, super high and bullish, and that's an in the price contract, guess what you bought? You bought that hype. You bought that hype. You assumed that risk. You better hope that there's more hype coming, or you're gonna lose money. What else we got, guys? Come on. I want to be here all night. Let's do Dude, with anything you do, guys, with anything you do, risk, more reward, right? Risk, more. I mean, that's always with anything you do. If you play, like a SPY contract, when SPY is grinding up bullish, Frank is in the chat saying, "Oh my God, SPY is going to gap up here. SPY is looking good," and you're buying you're buying when the getting is good. You're going to pay for it. You're going to pay for it. Whereas if you buy SPY when Frank is saying, "Oh my God, this is the bottom. This is the depths of hell. People are panicking here," and you buy that, guess what? It's good. You're in a good position. You have a good upside there. You have a great upside there. Potentially, if it doesn't break through the floor, and what I thought was death, the downside, what I thought to be the actual bottom, wasn't really the bottom. Perspective, what I was able to see, right? But if you manage your position and your risk, you don't give a fuck. You can trade every single call that Frank does, and as long as you're managing your risk, you'll never lose money. You're gonna make tons of money, just like Frank, because you're gonna be doing the same exact thing. Just manage your risk, and it depends on your strategy. The reason why it's so hard to manage your risk is because people don't have a defined strategy. If you have a defined strategy, your risk, as TJ likes to put it, is predetermined. Predetermine your risk. That's what having a defined strategy means. What is this? SYMC after ER drop. See, this is a good... See, thank you, Wiz Hard. This is good. No problem, Skyper. But see how this thing gets beaten up after earnings, right? So this stock looks okay. We like this stock. It's consolidating. It's an unhealthy consolidation. We're testing his bottom of support line more than we would like to, so we could tell that it's unhealthy, right? We could tell that this thing was going to dip because we have more tests at the bottom. But we're looking at the same thing. Sentiment is bad on this stock, but look how much it bet. Look at the earnings. What the earnings did to it. The earnings turned this stock into a piece of absolute dog shit. So if you buy calls in a situation like that, you literally bought people's dog shit. And if you buy dog shit, the chances of it turning into something better is much more likely than it turning into worse than dog shit. It's already dog shit. Does that kind of make sense? It's as bad as it can get. If you buy a gold bar and you expect to turn it into a gold bracelet, that's okay. You better make sure that you also know that you can melt a gold bar into a pile of gold, and then you can get dust and dirt particles into it, and it will turn into a pump of shit. So Diamond Offshore, look at Diamond Offshore. About $20 strike calls. The price is about $19.20. Beautiful. This is another good one. There you go, Wizhard. You want to take over? What did he do? I was up $600, went back to a message appointment, let the oil drop. Oh my goodness, that sucks. But this is another good example, to buy the calls, look how much this stock gets beaten up, right? So this stock gets beaten up at the beginning of this chart. You think the calls are a good buy there, so you buy some calls. You get a little pop. If you were smart enough to sell the calls on a little pop in that premium, good for you. But if you bought that time slot, somebody bought those
those calls, and now they're experiencing that more depreciation that we're seeing in the stock. So those calls are decreasing in value. To give an example, on his first blue line, you bought those calls for 40 cents. On his first blue trough there, you bought those calls for 40 cents. Then you sold those calls at his dotted line for 55 cents. Somebody bought them for 55 cents. At his next blue line, those calls were priced at 25 cents. So you buy them back at 25 cents. Now you go to his third blue line, and the price of those calls, they should be at around 40 cents, right? Based upon our first blue line. But instead, they're at 60 cents. What does that mean? That means that the sentiment on this stock is shifting. People are willing to pay more for the option to buy it, to call it at a higher price, to buy it at a higher price. You're willing to pay more. If you get to that second blue line, and instead of being at 40 cents on your, I'm assuming that these blue lines are even. I can clearly see that they're not that. But I'm just saying hypothetically. If you get to that third blue line, and the call price of that, the price of that call is at, 30 cents, you're like, shit, it should be at 40 cents. And now it's at 30 cents? But look how much time you've spent, right? Look how much time. If you had the contract ending in, what is that? I can't even tell. It's too small. November or whatever that is, you've given up all that time. So the contract isn't nearly as valuable as it is at the same price because you've sacrificed the majority of the time, even though sentiment has changed. And that's something that you'd have to take into consideration. If you don't take that into consideration, you're assuming all of the extra risk that is pertaining to that extra appreciation that this stock is the price of this option is getting that it shouldn't have gotten. And that's due to the lack of time. Skyper's last note was Exxon will go up. What's the next question, guys? Gotta wrap this up soon. Doing options trading. Charging.
Yeah, I don't really know what other questions I'd really have. The rest would just be studying on my own. Just piecing it together. So if anyone has some last minute stuff, go ahead. And then we could just go through and think of an option randomly or however Frank wants to do it. And we're all able to assess and do it. I think it's good.
Dude,
like insanely helpful for me personally. Because we were all just so close, but you can't always get there, and people don't like to give you the truth without making you read 3 books to get there. That's why.
Fuck reading free books, dude. You don't need to read 3 books.
I read a book my college career, and when I was in college, and I was pre-med, so. That's a good question. What's your percentage of traders for options? Right?
Not many. Very uncommon. I said it. A good majority of them will be hedged, but it's very uncommon for me to build long-term positions. But it also depends on your trading strategy. You know what I mean? Like my trading strategy does not call for hedging with options because I don't really need to that often because I'm trading the volatility that the market is producing for me. I'm not trading the volatility through the options. I'm not trading it through the percent of change of the idea of the stock price changing. I'm actually trading the stock price changing. So I'm getting the direct feed as opposed to paying a premium for the possibility, right? Giving myself the option. Funny how we go back to this word. But very uncommon. If I do trade options, I mess around with like a couple little small 10, 20 cents, and I buy 10 or 20 contracts, and I gamble it. I go for a Hail Mary.
Pause if you're going to send a message. It's okay. It's okay, but you don't have to delete that. But everyone just answer that poll because it's hard to know when people aren't talking on voice or anything. If you're good, just give like a positive response. If we see like 2 people have done it, then maybe someone will have a question. But otherwise, we can. Well, can I share names? Someone to follow? Yeah, that's fine, Wizard. We have some of them in the options room. I'll let it go. There's option sniper or snipper. I don't know why you suppose it's snipper. SWAT option. D2 follows a bunch of really good ones, which is he alerts on voice as well.
Dude, I'm surprised.
Surprised what you picked up?
A lot of people showed up. Thanks for showing up, guys. It's nice to hear people listening.
And as another student, thank you guys for showing up, because each one of us, like, when you guys would ask questions, I couldn't have thought of that, but it definitely helps. All about the options. How many followers do they have?
Dude, there's so many things that would. You should be researching a lot of the fundamental things about options. The best way to do it is to watch a couple 3 to 5 minute videos on YouTube about Options Basics 101 to get the general idea of what options are. Go onto SPY on Monday or any stock that you want, but I recommend something that with a larger market cap so that it's easier to gauge, and just look at them. Just see how the option prices are changing. Like if SPY goes up 0.25%, like what I would do is I'd make a little Excel sheet. I'd put SPY, beginning of the day, price 277. Then I would go down, I'd say 9:30 a.m. And that's the beginning of the day, obviously. I'd put the price of a SPY option at 278 was this, at 80 cents. Then I'd say the price of a 279 was 70 cents. The price of a 280 was 60 cents. And then I would write 10 a.m. right below it. And then I'd say, now at 10 a.m., the price of SPY is 277.5, and the price of the options changes in this way. Once you start gauging how the prices of the options is changing based on the change of the stock that you're trading or the ticker that you're trading, how the appreciation is appreciating or depreciating the value of those option premiums, that's what teaches you. That's where you can learn to see the value in either buying a 278 for 5 cents or buying a 279 for 10 cents, because you know the overall, the general idea how the price is going to react based upon how SPY is moving at that. Yeah. Yeah. Just study it. Just study it. We got about 15 more minutes, guys. I gotta close this up.
Yeah, just answer JD. That was a real question, I believe. How to use ratios when looking at options, or any symbol, or if you need one, how about micron?
Yeah, like I'm just saying, like that's the ratios I'm talking.
Okay, so
MU June 15th calls.
all right, everyone who's on voice and uses Robinhood for your options, let's all just take out our phones, go to Micron, let's go to options. I'm dumbing it down for myself, no shame.
June 15 calls.
June 15 call by. Cool.
So obviously the market is closed, so this is not can't of how it's going to change, but this is what you should be doing. The current price of MU is 61.43 at market close. The price of a 61.5 call. Okay, so let's think about this. Just in reality, and just use your head, use your brain. Price is 61.43, and we're in a very strong uptrend. Okay? What are the chances this going to 61.5 on Ziggy? Just play along with me.
61.5? I mean, yeah, we're definitely going to be going to 61.5.
Yeah, it's. I would say it's almost like a 90, 70. Because it went up $1. Another 7 cents thing, not much. So there you have it. I'm gonna buy that $1.34. It cost me $134 for one contract, right? Because my break even is very close. It's 2.3%. Now the reason why my break even is not 61.51 is not $60.51 is because I'm not getting this contract with zero premium on it, right? Somebody's already made money on this contract. Just today alone, so the owner of this contract has made 57%. What is it to 260? No, that's what I'm getting to. Yeah, so you're paying for the premium. You're paying for that, that $1.34. That's what you're paying for. That's what that $1.34 includes. It includes the likelihood. Yeah, see that now it's starting to make sense, right? So now let's think of it now. We're at 63. Close your mind. Forget about everything. Forget about nothing. You look at the 62 calls now, right? What are the chances of this going to 62? And I think to myself, well, it's not that unlikely. It's much less likely than 50. That's only 7 cents. This candle. 62 may be a little bit more resistance, may have a little psychological there, might be filling a gap. I don't know, right? So we don't do anything. I'm just gauging the option. Look at my break-even price between the $62 call and the 61. Can anyone tell me why the break-even percentage only 0.5% more, and I'm paying 20 cents less, which is what, 16% less on my premium? I just answered my own question. Fuck. The reason why my break-even is so close is because I'm paying 16% less on my premium. It's only 50 cents more. For that stock, that's less than 1%. That's 7-8%. So the stock only needs 7-8%, and that's going to include time, theoretically, the 61, 65, the 16% premium. That includes it. So that's what I'm saying, like the deviation between these two. So 61 over 5, 134, 62 over 112, 62.5 over 193, percent to break even, you have to calculate that in as a weighted average. You have to go, you need to go back to algebra, algebra class and take statistics. Like you need to go on YouTube and look that shit up.
So I like that all theoretically. So where would you actually take, if you wanted to enter my account, regardless if you like it or not, what would you do? What day, what would your call be, and what would you do?
Okay, so first, let's take a look.
It doesn't have to be even like super accurate, but just to give everyone
general. This is a fair question. Okay, let's take a look. Came out of a, right? We got a double top formation. So I look at this and I say, it's a good, I like the double top formation, bottom is good, and we have this nice little gap up here that didn't get filled. So I see that gap up that didn't get filled. I see down to fill it. Did we fill it there? I don't know. Okay, we did fill it. So we filled the gap down. Okay, so we gap down to fill the gap down. So extended pressure on top of over double top. Okay. So what I'm doing here is I'm trying to understand the sentiment. I'm trying to figure out where this, how confident am I in this stock? Is this just another gap fill to the upside? Is this running out of steam? Is this going to break higher to 64 to resistance? So those are the questions I'm asking myself. And then after I figure out the sentiment, how I feel about the stock, if I feel bullish towards it or not, then I go and I look at the option prices. So for this stock, I like this candle here. I think that the stock is fairly bullish. Stock has a good chance of pressing higher here. So let's see. Go ahead.
Oh no, I wasn't saying anything.
Okay, so I think, like I said, I think the stock has a good chance of going higher. But so now my next question is, okay, how much risk do I want to take? And if you go to the first page of Robinhood, if you're going to buy a daily contract, that's high risk, right? If I'm going to trade Monday, that's high risk. Because I'm only going to have one day. I'm only going to have a 9-hour shift to buy and sell my call contract for profit. If there's not a buyer at the end of the day who wants to pay a premium for that call contract to try to make up the extra five minutes that's left, if I sell it at 50, $3.50, if he wants to gamble with that 5 minutes to try to make an extra premium, it's very unlikely. That's why you don't buy a call, these at the end of the day. It's about to expire.
Sorry, I wasn't trying to interrupt. When this is your thought process, I think it's actually a big question. You just went to considering risk first before you would say, I think go to $64. Let me extend the chart in my mind. How many weeks would it take to reach the 64?
Exactly.
That's huge. Yeah, okay.
Dude, because if I think that this is going to go to 6, super. I'm going to assume more risk. I'm going to be like, okay, I'm pretty confident this is going to bounce hard. I have no reason to, be unconfident about it. And I don't need to buy a month out. I'm going to buy it for June 15th. I'll buy it for the end of next week. So that's like, you go, high risk would be a daily. Moderate risk would be like a weekly. And a monthly would be like, a couple weeks out to a month. You give yourself an extra time, you're going to take much less risk, right? But I'm going to tell you my own personal trading strategy. For me, I'm a high risk, high reward type of guy, or I'm a gamble, all or nothing type of guy. So I would either look at the June 15th. I don't trade daily. I would look at the June 15th, or I'd look at something like the July 13th or the August 17th or something crazy like that. for the sake of the argument, let's look at the June 15th, because I think this is fairly bullish right now. And I think that a 64, yeah, even as a noob, you can see that a $64 price target is not really that unrealistic. Resistance, you test resistance, even if you get rejected off, you could still have a potential to make money on this call option. So now I determine that I'm bullish. I'm short-term bullish, so I go June 15th. I'm looking at call bullish. Now, do I want to buy a call that's already in the money, or do I want to buy a call that's not in the money yet? And this is where I think a lot of you guys are asking me a lot of questions. How do I know which one to buy? Value investing, right? Value investing. So I look at these calls. I say, okay, Frank. I speak to myself. I say, Frank, $61 is priced currently at $1.60. Okay, $61 call at $1.60. Current price is $61.43. We're 43 cents away from a $61 call, and the price is $1.60. Okay, then I go to the $61.50 call, and I say, okay, $61.50 call. We're 7 cents away from $61.50, and the price of this contract is $1.34. Okay. I know what I need to get there. I know how far I know how much. Like I said, when you're buying a call option with money, you're assuming that risk. So I know how much risk I'm assuming to the downside with my $61 call with 40 cents, and I know my upside that I'm trying to determine with my call, with my 61.5 call, is 7 cents. Now what I need to determine is how much premium am I going to pay, right? That's what we're all trying to figure out. How much premium am I going to pay? Now my break-even price on a $61 call is $62.60. Okay, so this stock needs to go up 1.9%. If we're going to use the actual number, $1.17 for me to break even. So, like I said, this is all going into a proportion ratio. $1.17 is what I need to break even. Then I look at the 61.5s. And I say, okay, this needs to go up to $62.84, which is from current price $1.40 or $1.41. And then I say, okay, this stock needs to go up $1.41 to break even, and I'm paying $1.34. So would I rather pay $1.60 for it to go up $1.17? Would I rather pay $1.34 for it to go up $1.41? Now you ask yourself these questions out loud to try to make sense of it to yourself. It's making sense, right? We understand why this is making sense.
I'll answer yes.
Okay.
It's a two-type question.
So now we're determining the risk that So we've evaluated that in the money, evaluated something that's out of the money, evaluated by how much. We evaluated the premium that we're going to pay. But now we need comparative data, because if we don't know, we have nothing to base this off. These numbers that we just created with these ratios do nothing for us unless we go back and use history. So now we look at the $60 calls, and we say, okay, $60.50 calls are at $1.89, and the break-even price is $62.39, which is whatever 86 cents above this current price, which is 1.56%. So now it's another additional 29% premium. So what I like to do, this is very simple. Don't even look at anything. Don't look at nothing. Don't look at anything but the premium price. Go from $1.60 to $1.89 to $2.21 to $2.55. So from $2.55 to $2.21 is 34 cents. $2.21 to $1.89 is 32 cents. 33 cents. Am I right? No, 32 cents. So 34 cents, 32 cents, and now from 189 to 160 is 29 cents, right? And this is what I'm trying to explain to you with gauging the price. So the premium that we're paying on these contracts the spread is decreasing, right? 34 cents, 32 cents, 29 cents, right? So when the spread is decreasing like that, that tells you that that tells me that I'm coming closer to paying premium for this option. Does that make sense?
Yep.
If the 61, I gotta open it back up. Hold on one second. If the 61s were 160 and the 60.5s were
159, I would know, okay, this is coming to the end of the premium. People are, buying. You're never going to see that. You're never going to see that because it'll never be that bullish. Why would you spend 1 cent to get 50 cents? And that's where it comes down to, right? Why would you never do that? Why would you never pay 160 for the 61 calls and 159 for the 60-50 call, 60-50? Because it's a 50-cent difference, but it's 1 cent on the premium. You know what I'm saying? That's why you would never see that. You would never see that because any logical trader would take that. They would take that deal, right? One or the other. They would determine one or the other to be the better option. And obviously, the 61 would be better because you're not paying for any more premium. You're getting the same call. You're getting a better call, more in the money call for less premium. You buy the 65s for 159 and the 61s for 160. So why would you not buy the 65s for 159, right? Only going to be more and more in the money. And you have more to the downside that you could lose to be out of the money. So you're looking at the spreads. And then you look at the spread to the upside, 134 to 112, so 22 cents. And then 112 to 90 cents, which is 19 cents. And you have 90 cents to 76 cents, which is 16 cents. So you can see how the spread is decreasing there, right? As we get further and further away from the price. Am I making sense here? Is everybody with me? My throat's killing me.
Yeah, no, I'm definitely following you. So what I think would be a good little wrap up, and to not waste time, if you look up for Pursuit of Happiness had a question, which I think is a good question. So if he would buy the call, I answered it, which relating it more to stocks, but it's not really applying the concept of options. And then beyond that, I just wanted to post the open interest and everything of this contract itself for everyone, and that would pretty much be everything to be doing options if we could go over that.
Okay. What are we looking at? These.
I'll repost for him.
Man, it's been 2 hours already.
Yeah, you're the man.
So the hardest thing for me is if you chose the June 15 calls, how long do you stay in it? This is a good question, guys. Okay, this is a question I've actually been waiting for. So this is what you really need to be mindful of, right? You can't stop. Nobody can stop time. So when you open your position, think of somebody flipping over an hourglass, right? So you flip over the hourglass and the sand starts to run. And when that sand runs out, your opportunity to make a gain on this option is gone. So as the sand drains to the bottom part of the hourglass, the opportunity to make money lessens just based off of time alone. That's why theta or time change can kill your position. Bless you. Because if you're holding it for an extended period of time and you're not getting the appreciation that you require to essentially outpace the time, right? It's kind of like what I'm trying to get out of here. In other words, if you have if you have the June 15 call, right, and that's a week out, and for I'm assuming you mean for $64, and you're asking how long do you stay in it? So we're at 61.43 on Monday morning. We open up at 61.43, and let's say on Monday evening we close at 62.23, which is let's keep it simple, 62.43, which is another $1 up. So we're $1 closer to your call option, and your call option has increased by 20. Just using the number here, by 20%. So then you say, okay, my call option is up 20%, and we're $1 closer to my execution of my call target, right? So then I would ask myself, I'd say, okay, I've made 20% for $1. There's how much profitability is remaining in terms of my call option Friday. I need to get to 64 by Friday for my call option for this to be, the good perfect scenario call option where I can execute my call. So you're looking at this, you're saying, well, I'm up $1 and I'm up 20%. So, but you don't sell. You're just trying to gauge, if you should sell or not. So you go into Monday, price opens up 62.23 or 62.43. You're up 20%, and your call option, and you're trying to see, should I buy or should I sell? So you're looking at people who are trading. You're looking at the open interest in your call, saying, okay, people are trading this. Okay, going up. I'm up 15%. I'm up 25%. I'm down 5%. I'm down 5%. I'm down 10%. I'm talking about on the day now. I'm down 5%. You're fluctuating. You're fluctuating, right? And you're saying, I'm trying to determine whether or not I should sell this. So if, let's say, for instance, the price of MU is at 21.43 and it goes down halfway. So it goes down 50 cents and you lose 14% of your premium on the 20% that you made. Does that kind of make sense what I'm trying to do here? Does that kind of make sense? You went halfway down on your appreciation, your depreciation. You depreciated halfway down on your appreciation. You came down 50 cents, but you lost 14% on your premium. Hypothetically, if you had unlimited amounts of time, right, if this contract was not definitive, if it wasn't going to end Friday, then you should have just lost 10% of your premium because you lost 50% of what you gained in terms of appreciation in the stock, in terms of bullish attention towards the option itself. But because you used up one day, now you have one less day. So now you take away 20% of your time as well. One out of your 5 days has been used. So that's why you pay another 4. You're not necessarily paying it, but you lost 4% of your premium because you held for another day. Does that kind of make sense for you? Like, how long do you stay in it? You stay in it as long as the appreciation is keeping up with your premium. Does that kind of make sense? Once the premium is costing you, then the stock is depreciating. That means that time is not of the essence for you. That means that time is hurting you more than it could be helping you. Does that kind of make sense? You said absolutely. I like that. So do you keep evaluating the charts or do you take a nice part? So, I mean, yeah, like I said, that goes to trading the stock. That's dip buying and dip. Oh, mute your mic. Ziggy, can you hear him?
Is that me? Oh, yeah, I'm mute.
So yeah, that that's taking control of your position. If you bought 5 contracts, price goes, you lost 14% of your premium. You only want to sell 2 contracts. That's because you still think that it's still bullish and you think that it's going to be a dip buy. So you don't want to give up too much of your position. So I mean, you manipulate the amount of you're holding long or short through a contract, just as you for the physical position trading the actual stock, based on how you feel towards it, how sentiment is changing. Right? If it dipped down 50 cents and it continues to look bearish, get the fuck out. You know what I mean? Like, it came down, like I said, 50% correction. It's probably a weak stop. Or if the charts keep looking good, there you go. So if the charts staying, if it's looking good, if it's a healthy dip, if it comes down, a perfect scenario for you, like let's say, using this example, 62.43, let's say the price goes down 10 cents. It goes down 10% of the appreciation that you saw. You lose 1% on your premium. What does that tell you? You lost 1% on your premium. That means that you have a bunch of motherfuckers who are not motherfuckers, but a bunch of investors who are still interested in your option, your call option, even though at almost the same price, it's down 1% on the premium, even though you lost 10% of the appreciation, which means that the stock is actually more bullish than you could ever have anticipated. If I was in an option in that situation, you would have to pry those call options from my dead hands, because at that point my downside is minimal, right? I have relative strength to the downside. That was a good question. Thank you.
Yeah, that's pretty much saying it's 10 p.m. This is just like perfect because I do think we're at a point where we're able to wrap it up. I think most people have had their questions answered. I've had all my questions answered. We're able to see it all, where if anyone else feels like they want to do some extra work after, I know we mentioned like homework or anything like that, but unless Frank has a specific idea, I think it's something we could do more so going forward, where we could have some of us, when we're trying to do a lesson, come up with like a more structured thing rather than piece it together right now. But I would be interested in personally just like coming up with something with one of you guys to like do something to help us like all out. But thank you, Frank. Seriously, dude. I've been struggling with options for so long. We're getting it straight up. It's very, very helpful.
Oh, my pleasure, man. I'm glad you guys all.
And I'll be hanging around tonight. I'm not doing much on this Friday night, so I'm probably going to do some due diligence. I don't know why it sounds so serious. Do some DD, like look at some charts and tie it back to options if anyone's hanging around tonight.
And guys, the best way that you can, like I said, like take it upon yourself. When Monday rolls along, post on the trading floor, say, hey, Frank, look at SPY options right now, and we'll look at SPY options together, and we'll go with them, and just track the data. Like I said, SPY currently 277.5, option price 270, option price for Friday 77 cents. If you just do that, and like I said, it's going to be like night and day for you. You're going to open up the options, and you're going to be like, I want this option 100%, 1,000%. This is the best option to buy. And then you're never going to have to worry about anything. But it's much better, like I said, once you understand the whole stock, the overall sentiment of the stock that you're trading the option comes second nature, right? If you know the beast, then you know how you could milk the beast with using options. And that's really what options are for. It's for milking the beast. It's for taking advantage of smaller moves using higher leverage amounts of capital. But yes, it is 10 o'clock for you guys, and my throat is killing me, and I need some chapstick. So if you have any questions, feel free to PM me, and we'll get back to you when I can. Ziggy, you have a great night, great session.
You too, my man. Thank you guys for all coming out, even when I didn't necessarily know what I was doing at first. We are all able to piece together. You're the man, Frank.
There you go. God bless.
And if anyone has any questions or anything, just feel free to hit me up individually. And let's look at some tickers, boy. I don't necessarily want to do it in this room, but that was great. And then everyone else could either go through what we had in this chat or go do the live stream on YouTube, which I'm very thankful we had that too. So I'm going to do some DD. I think JC is able to end this stream and begin a new one where we could do some DD and be able to just have it recorded and go over that and do some analysis. I don't have much to do. Not in a depressing way. I kind of enjoy this. This was a great night. Productive. And again, so many people that are muted, it's only because we have so many members. Like, if anyone wants to be like unmuted, just feel free to ask and then we can talk it out. You don't have to type. It's not punishment. It's just we have to when there's so many people. Funny stuff.